Do you feel like you're doing everything right with your money but still can't seem to get ahead? It's frustrating, right? You work hard, earn more, and yet, building wealth feels like an endless uphill battle. What if I told you that some of your normal financial habits are actually the ones keeping you broke? In today's video, we're diving into 5 money habits that might seem totally responsible, but in reality, are silently sabotaging your financial future. If you're ready to take control of your money and start making real progress toward your financial goals, let's jump right in. 1. Succumbing to lifestyle creep, spending as income grows. You've probably heard the saying, live below your means, but do you actually follow it? Most people get a raise, a bonus, or even a promotion and immediately feel the urge to reward themselves by upgrading their lifestyle. This could mean buying a bigger car, moving into a nicer apartment, or even splurging on luxury vacations. It feels great, right? But here's the catch. If your spending rises with your income, you're not actually increasing your wealth, you're just maintaining the status quo. Lifestyle creep is sneaky, and it's one of the most common reasons people stay stuck financially, even as their income increases. You might think that upgrading your lifestyle is a sign of success, but in reality, it's a trap. Every time your income goes up, your lifestyle should not automatically follow suit. Instead of upgrading right away, consider waiting at least a year before making major purchases. This gives you time to save and invest the extra income you've earned, allowing it to grow and work for you. Wealth is built in the gap between what you earn and what you spend, so the key to financial success is maintaining your lifestyle while saving and investing the difference. It's easy to feel like you deserve things after a big paycheck or raise, but making intentional decisions to hold off on that upgrade can set you up for long-term success. Imagine the financial freedom you'll have after saving and investing that extra income for a year, rather than spending it on things that offer short-term happiness. It's all about maintaining discipline. Building wealth isn't about the immediate gratification that comes from flashy purchases, but about the long-term rewards of smart decisions. 2. Paying yourself last. Many people have the habit of paying their bills first and saving whatever is left over at the end of the month. The problem with this approach is that there's rarely anything left over. Life happens, unexpected expenses pop up, impulse buys happen, and before you know it, your savings account is empty. The pay yourself last mentality puts your financial future at the mercy of your spending habits, and that's not a winning strategy. Instead of leaving savings to chance, adopt the pay-yourself-first strategy. This means automatically setting aside a portion of your income, at least 20%, into savings or investments as soon as you get paid. It's a simple strategy that ensures your future self is always prioritized. Treat savings like a non-negotiable expense, just like rent or utility bills. By making this automatic, you won't be tempted to skip it, and you'll be building wealth without even thinking about it. The pay-yourself-first approach ensures that saving becomes a priority, not a luxury. Instead of looking at your bank account after all your bills are paid and trying to figure out what's left to save, you make saving the first thing you do with your income. This strategy helps you stay focused on your long-term goals, knowing that every paycheck will automatically contribute to your financial growth. One of the keys to financial success is discipline, and paying yourself first sets the tone for financial responsibility. Think about it this way. If you can prioritize saving from the start, everything else will fall into place. 3. Relying on safety in cash. We've all been told to keep cash in a savings account for emergencies. It feels safe, doesn't it? However, keeping too much money in a traditional savings account is actually a silent wealth killer in today's economy. With inflation outpacing interest rates, the purchasing power of your money is shrinking. Your money is just sitting there, losing value over time. The longer you keep it in a standard savings account, the less it's worth. In 2026, the cost of living is rising, and if your savings aren't growing at the same rate, you're falling behind. The money in your savings account may feel safe, but it's losing value to inflation. Instead of keeping idle cash in low-interest savings accounts, consider putting it into high-yield accounts, stocks, or other investment vehicles that offer better returns. Index funds, real estate, or even bonds can help your money grow over time, keeping up with or outpacing inflation. The goal is to keep your money working for you, not just sitting around. While it's important to maintain an emergency fund, beyond that, having large sums of cash sitting idly can be a missed opportunity. Invest your money where it has the potential to grow, and make your savings work for you, rather than being passive in a savings account. If you can't commit to investing right away, consider starting small. Open a high-yield savings account or explore low-risk investments that generate more income than a standard savings account. 4. Making only minimum credit card payments. It might seem like you're doing the right thing by making the minimum payment on your credit card each month. But here's the truth. Paying just the minimum will keep you in debt for years and cost you far more than you initially spent. Credit card interest rates can be as high as 21% to 22%, which means the longer you carry a balance, the more interest you'll pay. For example, if you have a $3,000 credit card balance and only make the minimum payment, it could take over 15 years to pay it off, and that's not counting all the interest you'll pay along the way. Credit cards can be powerful tools when used responsibly, but they can also lead to a compounding debt trap when misused. Instead of focusing on the minimum payment, prioritize paying off the balance in full every month. If you can't afford to do that, focus on paying down the highest interest cards first using the avalanche method. This will save you more money in the long run and help you get out of debt faster. The key here is to break the cycle of only paying the minimum due. If you're regularly carrying credit card debt, you're not really using them to your advantage. Credit cards should be tools to help you build your credit and earn rewards, not a long-term debt trap. Taking the time to pay off your balance in full each month will not only prevent interest from accruing but will also keep your credit score high, making it easier for you to get favorable loan terms in the future. 5. Ignoring small purchases. It's easy to overlook small, daily purchases like snacks, coffee, or online impulse buys. But over time, these seemingly insignificant expenses can add up to a huge chunk of your monthly spending. Maybe it's a $5 coffee every morning, a snack from the vending machine at work, or an online shopping spree every weekend. Individually, these purchases don't seem like much, but collectively, they can total hundreds, or even thousands, of dollars each year. The problem with these death by 1,000 cuts expenses is that they are often overlooked. Since each individual purchase seems small, it's easy to justify. However, when you add them all up, you might find that they're taking a significant portion of your income. Take some time each month to track these small purchases. You may be surprised by how much money you're spending on things you don't really need. Cutting back on these small leaks can free up a surprising amount of cash that you can redirect into savings or investments. The issue is that these small, recurring purchases don't raise immediate red flags. Since they're relatively inexpensive, it's easy to justify them. But those tiny purchases add up over time and can steal a significant portion of your budget without you even realizing it. This is where budgeting and tracking expenses can make a huge difference. By cutting back on these small, unnecessary purchases, you'll be amazed at how much money you can save without feeling deprived. The key is consistency. By making a habit of questioning every small purchase, you'll be better equipped to prioritize your long-term goals. There you have it. 5 common money habits that might seem normal but are keeping you broke. From lifestyle inflation to ignoring the small, everyday expenses, these habits can silently derail your financial future. The good news is, once you recognize these habits, you can take immediate action to start making smarter financial decisions. Remember, wealth isn't just about how much you earn. It's about how wisely you manage and invest what you have. If you found this video helpful, don't forget to like, share, and subscribe for more tips on managing your money and living a financially secure life. Thanks for watching, and we'll see you in the next video.